It's been said that the market can do one of three things. It can go up, it could go down, or it can move sideways. However, most traders are only concerned about two of these three scenarios: markets that trade up and markets that trade down. This interest has likely developed through the age-old advice handed down through generations to buy low and sell high. However, this strategy is not always as straightforward as many traders would like for it to be. Trends are often not as clear, consistent, or as prolific as traders expect when they enter the market. So what alternative to this discretionary mainstay do traders have? Range-based trading. What is range trading? It's exactly as the name suggests, a period of consolidation or congestion where price action does not produce a clear bias through a steady development of higher highs or lower lows. Of course, this is a broad definition and can encompass a period of volatile chop with no clear boundaries on either side of the market on one end of the spectrum, all the way to a perfectly horizontal band of repeatable swings on the other. It goes without saying that the more definition a range produces, the easier it is to base a trade around. And regardless of your preference, you can apply range trading strategies to all time frames, small or large. Now let's move on to building a basic range trading strategy. First and foremost, we're looking for a repeatable pattern of congestion or a trading zone that has established resistance and support over a period of time. This type of condition provides for an increased likelihood that price action will remain within the trading zone for a period of time, like you can see here. Obviously, the longer it does, the easier it becomes to place buy and sell trades and manage those trades with stops and limits. Many traders like range trading strategies because the where do I buy and where do I sell question becomes less of a hurdle. Good range trading conditions provide fairly reliable support and resistance levels that help keep price action contained, making it easier for traders to decide when to get into and out of trades. Many traders consider two successful tests and retracements at support and or resistance as confirmation that a range is in place. However, I like to see 3 points of confirmation before I consider a range has been set up. Let's look at a few ranges to get a feel for what this technical pattern can look like. As you can see, ranges can come in different shapes and sizes, but the general definition of the channel is the same throughout. Perhaps the most useful element of the range trade is that it offers a clear area to enter the market and to place stops. Let's begin with analyzing where to enter the market. Optimally, we want to find an entry as close to support and resistance as possible to take full advantage of the trading band while further being able to place a stop that does not involve too much risk. This does not mean, however, that we should hold out for an entry that is at the very edge of the market like we see here and here. Depending on the width of the range, anything in the top and bottom quartile can be considered a good region for entry. With this rule of thumb, you can see that there are quite a few times that price action came into these regions, allowing us to enter a number of range trades if we wished. For me personally, because I like to see 3 points of confirmation before I enter into a range-based trade, I probably would not have entered any trades in this area here. I would, however, have been watching price action closely after this time, and as prices begin to swing up towards the upper band of the range again, like they have here, I'd certainly be at my computer ready to take action. For this video, let's go ahead and assume that we placed a sell position around this level, near the high of the range or this resistance level. Again, we certainly could have also sold here and here, as both of these areas have price action in the upper quartile of this range, or if we were looking to buy, we certainly could have gone long at this position as well. But it's up to the trader to decide which trades they wish to take and how much confirmation they need before entering into a position. Now let's talk a bit about where to set our stops and limits. We're going to pull up a new chart briefly to explain an important concept used for placing stops, but we'll return to this example shortly, finishing out the management of this trade. When deciding where to place your stops, this should be first and foremost defined by the technical situation. Go ahead and look back over the life of the range. Was there ever a spillover on the trend line that defines the border of the range since its development, like you can see here and here? Has the market stalled at the extreme of its band for an extended period of time before retracing? If either of these cases comes up, we'll want to place a wider stop to account for any tails or possible surge in volatility that presents a false breakout. So in this example, we might want to set our stop somewhere in this area here, beyond the deepest spillover, to give ourselves a bit more cushion in the trade. And another consideration for placing stops is the actual risk or loss, or in this case dollar loss, on the trade. Most good traders prepare for and expect the worst. So after setting the stop through technical considerations, we need to also calculate the total risk we'll be taking with the position. If the loss would be too large to sustain, we can try to decrease our position size so that it is reasonable. If this isn't possible, it's best to just move on to the next trade. We should never compromise a sound trade by thrusting it into the risk profile that we're not comfortable with. Now let's return to our previous example to look at the technical situation to decide where a good place to set up our stop will be. We can see that after entering our short position, prices began moving up towards an extreme within this range. Therefore, history would suggest that it's likely the market will reverse at the same level. Also, this range doesn't have any big spillovers that we need to be concerned with all the former price history actually touching the upper boundary and immediately reversing course. Therefore, I'd look to place my stop somewhere beyond the upper band, somewhere around this price level here. Now we need to look at the opposite side of the trade as well. Let's assume our trade is currently in the money. Where do we take our profits? This, like placing a stop, is a point of debate, and it truly depends on the trader themselves. At the same time, there are important guidelines to follow regardless of your ultimate objective. The closer you set your target, the more likely and quickly it will be hit. Following the same line of reasoning, the further away the target is, the less likely it is that the market will meet that level. Consider, it takes time to traverse any distance in a market, and price action can only move so far over a certain period of time. The further the market has to move, the greater the opportunity for an exogenous factor to slow the progress towards the opposite range boundary and even reverse course. Now, as a basic rule of thumb, we recommend traders try to achieve a 1-to-2 risk-to-reward ratio or better in their trading. Of course, several other considerations need to be taken into account when considering where to set your stops and limits, including the pair you're trading, the width of range, current volatility, your trade size, the size of your account, among other things. As you can see, good money management, which is highly important to a good trading strategy, does involve a number of different considerations. In fact, we put together a video specifically on money management for this very reason, and I recommend that you watch this video as well. But for the purposes of simplicity, let's just stick with the basic 1-to-2 risk-to-reward ratio, and let's look to set our limit somewhere in this area here. This provides us with a pretty good potential outcome on our trade if all things play out as we planned. Now, let's go ahead and recap what we've discussed in this video. To locate good range trading opportunities, it's important to follow these basic guidelines. First, locate a currency pair whose price action is currently consolidating and moving sideways. Avoid pairs whose price action is steadily creating higher highs or lower lows. Next, look to sell in the upper quartile of the range, and/or look to buy in the lower quartile of the range. For your stops, look over the technical situation of the currency pair and see if there are any spillovers or tails that have formed outside of the range. If there are, it might be best to widen your stop outside of these extremes. If there are not, it's most likely okay to place your stop just outside of the defined range. For your limits, determine the condition of the market, the pair you're trading, the width of the range, among other things, and set your limit appropriately. And again, as a rule of thumb, we recommend a 1-to-2 risk-to-reward ratio or better. And there you have it. We've just discussed how to recognize range-bound market conditions and how to locate trading opportunities within them. Specifically, range trading can assist traders with more confidently deciding where to enter and exit their trades and where to set their stops and limits. Additionally, we've demonstrated how developing a range trading strategy under the right market conditions can be a very viable approach that many traders might consider. So we appreciate you taking the time to watch this video, and we wish you the best of luck in your trading.